Hey guys, Eric here, Mr. Fired Up Wealth, and I just want to do a quick video here today. It's the day before Thanksgiving in the United States. Tomorrow I'm going to be eating some turkey, drinking some beer, watching some football. So I want to do this quick video on Nike for two reasons. Number one, to show you again the power of dividend growth investing and compounding interest and dividends, and showing you how DGI can work, especially over the long term. And number two, to discuss and show you an example of where you should let your winners possibly run versus taking chips off the table and taking some profit. When do you know to take profits off the table and when not to? And that's a little bit of a personal preference, but I'll give you my take on it. So let's just dive right into this. Nike, all right? You can see my wife and I bought, back in August of 2012, we bought 79 shares at a cost basis of $24.09. That price back then was $1,903, and it's up almost 300%. Now, if you look up here, it shows an unrealized gain or loss of a positive 250%. Obviously, I reinvest my dividends. So when you look at this, the true investment is $1,903. This total cost basis up top, that includes the dividends reinvested. Of course, Nike is not a huge dividend payer. So if it were a higher dividend, this would be even more skewed. But the point of the matter is it's a $1,903 investment that's now worth $8,272.33. A pretty good run. So what's the whole point of this? So Nike is, it's DGI, but DGI can mean a lot of different things depending on the risk tolerance of the person. AT&T is a DGI stock, but so is Nike. Here's the difference. Nike, to me, is a growth stock that pays a dividend that also is growing its dividend. So it's a growth DGI. There's, regular DGI. Some investors, all they care about is, I've already got capital. I've got millions of dollars. I'm going to buy, an AT&T, or I'm going to buy a bond or whatever. And I'm going to basically get a yield off that so I can, get an income and pay for bills. If you're in your 20s or 30s, and the reason I'm making this video is a lot of the people that I talk to in our Facebook group, in the Fired Up Wealth Facebook group, and if you haven't joined that, please do. A lot of people that I talk to, just an instant messenger that I mentor, etc., they're younger than I am. I'm 40. A lot of these guys are 20 and 30, in their 20s and 30s. Companies like Nike are perfect for that age group, because they're growth stocks that are still giving you the value of DGI. And when you're in your 20s, you don't even need dividends necessarily. You just buy, risk. You can be risky. You can buy growth stocks, and you're going to slowly convert that. So a company like Nike was perfect when I was in my 30s to buy that. It was, 7 years ago. So I'd have been in my early 30s. That's exactly the type of company that you want to find. Now, Nike is still a good, I think, long-term hold, but is it going to grow 300% in 7 years again? Probably not. It's possible, but probably not. So the idea now is to find, if you're 30 years old right now, or in that age group, in your late 20s, early 30s, mid 30s even, how do I find the next Nike? What stock is going to perform like that then I can, I can maybe sell some of my profits and keep the rest, and just let that run and keep, as the dividend grows and the company keeps growing over the years, a company like Nike will probably be around for a long, long time. When I think of growth dividend stocks that are now getting mature, I think of like the Costco's, the Home Depots, the Microsofts, things like that, where they've been growth stocks that also have a DGI component. NVIDIA, I think, is a great pick even today, especially if you could have bought it, when it was hammered down. This time last year, guys, it was just a steal. I was buying the hand over fist, and it kept going lower, and I'm thinking, what the heck am I doing? But it's really played out really well for me. These are the kind of stocks, though, that can really make your portfolio, and the key is to try to find companies like this. So what qualifies for a company like this is going to be a company that has some kind of catalyst. So back in August of 2012, the reason my wife and I bought Nike is we're huge NFL fans. We do fantasy football, the whole bit, and they announced around that same time a long-term license agreement with the NFL for Nike products on their jerseys, etc. And that was an exciting marriage for us, enough to where, we knew we wanted to be in the stock. We thought just that catalyst alone would be enough for the company to do well. And they've, had tons of other things like, if you're into soccer, so like FIFA soccer, they've got all these different partnerships, even with college sports, etc. Things that we wouldn't have even imagined that they would have done in 2012. But that was the catalyst to at least get our excitement. Then we did our due diligence. Back then, it probably wasn't nearly as much due diligence as it is now. It was a lot of gut. When we bought Costco and we bought Home Depot and we bought Microsoft, it was all stuff that we used that we liked. And I still do that to this day, but my investing style is obviously much different, and the way I analyze stocks is a lot different. But at the end of the day, if you're in your 20s and 30s and there's a company that you like and all your friends like, and you see it being around in 5 or 10 years, it's probably something that you should look into more to invest in. That's how a lot of this stuff works. You think of all the companies that have really done well over the past decade. You could have gone back 10 years and said, will Amazon, be as big? There's no way to really know. But if you really look at it, okay, so today is 2019. What's going to be big in the future? Microchips. AI, right? Autonomous driving, cloud software, right? All these things that you can look and say, well, this makes sense. These companies that are focused on these things, they're in these long-term growth trends. And Nike would have kind of been in that whole category because there was so much room back in 2012 to grow. Did we know it was going to grow the way it did? No, but we knew that Nike would probably be around for 10 years and do all right. And that's what got our interest. So that's the kind of company you should be looking for. And as you get older, you're going to sell some of the profits from these growth companies that pay dividends. You're going to convert that into things like AbbVie and AT&T. I don't necessarily want 20-year-olds to be buying AbbVie and AT&T. You're not going to outperform the market. If you want a portion of that for dividend, great. But try to find growth companies and try to be diversified and try to have a balance of, core ETF, growth that maybe has no dividend, maybe a little bit of growth that has DGI like Nike's. But I don't want you going out and buying just REITs and energy stocks when you're 25 years old. That's not doing yourself a favor. Now, of course, if a bear market happens tomorrow, you'll say, why didn't you tell me to buy those? Okay, great. You should have a component. You should be diversified. You should have a percentage. I'm just saying, don't go buy 80% of your assets in 6% dividend yielding stocks when you're in your 20s, because your chances of outperforming are pretty low. Try to find companies like this. The second point I want to make with Nike, so you can see that back then we always bought $2,500 at a time. So if you looked under the closed lots, it'll show 25 shares that we sold for $58.51 in 2017. So obviously we sold about a quarter of our position. We took 120% gain, sold it at $58.51, and now it's trading at $94.25 as of this morning. So either way, this stock was 24, it's almost 100, so it's gone, it's basically a 300% gaining stock, 291%. We sold in 2017. The reason we did that is sometimes you got to take some chips off the table. We had a 120% run over 5 years, and that we considered that a pretty good run. We decided to keep 3/4 of it and let it run so that you kind of hedge your risk. If the stock goes backwards and falls, at least you took some profits. If it goes forward, well, coulda, shoulda, woulda. But sometimes at some point, and you have to decide what your number is. Some people shave at 70%, some at 300%. It just depends on your preference. I like to get to about 100%, 150% gain, and then take a quarter off the table, let the rest of it run. Now, obviously, if the story changes, then you're going to sell the whole thing, right? If all of a sudden, there's a big scandal and you think this company is just going to tank over the next couple of years, you might consider selling it all. You can always buy it back later. But right now, I like the long-term story with Nike. I think it'll still trend upward. I don't think it'll necessarily grow at the rate it has grown over the past 7 years. But I don't think it's going anywhere. The dividend continues to grow, and it's an expensive PE ratio right now. I wouldn't necessarily go buy Nike shares at this price. I'm simply showing you an example of how you can buy something, for $24, and in 7 years it can be worth 300% more than it was when you bought it. That's the whole point. So I hope this video was at least helpful. Again, I want to show the power of how long-term investing and dividend growth investing can work for young investors. I don't necessarily want people in their 20s and 30s to go out and just buy MO and AbbVie. If that's your risk, if that's your suitability and you want zero risk, that's fine too. But at some point there, you also want to look at some bonds and some other things. For me, I'm more of a stock and cash kind of guy, kind of ride or die with the market, and maybe that'll burn me someday, but it served me well. And I'm going to continue to invest in companies like Nike. I'm going to take profits from companies like Nike, and then I'm going to buy. So when we sold our 25% of Nike in 2017, our 25 shares, we bought AT&T. And that's done very, very well. And at that point, it paid 6-7% yield. It's letting your money work for you and work even harder. And now it's diversified, it's hedged. If you were to actually do the math on everything, basically, I would say that this $1,900 is already paid for itself with the gains and the dividends and we've sold some profits on AT&T. So really, when you look at it, you have an $8,272 that really you didn't pay for. And if it goes to zero, obviously you lost $8,272 on paper. But because your money works so hard for you, if that goes to zero, you actually are back to par. I don't know if that makes sense, but that's the whole idea, is that you save money, you keep it long term, you take some profits, you shuffle it around, and you make your money work even harder for you, get a higher dividend, collect some cash while you're sleeping. So tomorrow's Thanksgiving. I hope you guys, if you're in the United States, have a great holiday. Safe travels to you. For everybody else that's not celebrating Thanksgiving, obviously have a great rest of your week and a great weekend. I appreciate your time, guys. Please do subscribe if you haven't already. Click the little red subscribe button bottom right. Click the little bell so you get notifications. I'd love comments from you. If you haven't joined the Facebook group, it's Fired Up Wealth. Take a look. Join us there. Hope you have a great rest of your day. Take care.